10 reasons not to pay off your mortgage early. Nowadays, many homeowners feel pressured to pay off their mortgages as quickly as possible to lower monthly expenses and eliminate debt. While paying off your mortgage early has its benefits, it may not always be the smartest financial move. Depending on your financial situation and long-term goals, keeping your mortgage and redirecting extra funds elsewhere could be more advantageous. In this video, we're sharing 10 reasons why you might want to think twice before paying off your mortgage early. Stay tuned until the end. 10. A mortgage can help produce passive income. A rental property can generate passive income, earnings that require minimal effort to maintain each month. Additionally, tenant rent payments help reduce mortgage debt, and there may be tax benefits associated with property ownership. Some homeowners choose shorter mortgage terms, such as 15 years instead of 30, to pay off their debt faster. However, doing so doesn't always accelerate wealth accumulation. While eliminating debt quickly may seem appealing, it can mean missing out on valuable lifestyle and investment opportunities. The biggest argument for paying off a mortgage early is avoiding interest costs. However, by applying the principle of positive carry, investing your money elsewhere, you may achieve greater financial gains. Our next point will explain this principle in more detail. 9. The concept of positive carry. The concept of positive carry involves taking advantage of the difference between a loan's interest rate and the returns generated from investing that money elsewhere. For example, if your mortgage rate is 5% but your investments yield 8%, you gain a positive carry of 3%. By leveraging positive carry, you can effectively earn a profit using borrowed funds. Over a 30-year loan, this can add up significantly. For instance, investing $1,270 per month at a 3% compounded monthly return over 30 years would grow to $745,089. The key is to allocate funds toward an investment that generates that 3% carry. That sounds like a smart financial move, but don't go away just yet. There are more reasons why paying off your mortgage early may not be the best choice. Let's move on to the next point. 8. High early redemption fees and extra costs. When offering a mortgage, most lenders expect borrowers to maintain the loan and consistently pay interest, as this is their primary source of revenue. With a 30-year mortgage, lenders aim to keep you making payments long-term to maximize their profits. As a result, many lenders include an early repayment charge, ERC, if you pay off your loan ahead of schedule. This fee can amount to several $1,000s depending on when you repay. So, if you settle your mortgage early, you could face a hefty penalty from your lender. To avoid this, you might reconsider paying off your mortgage too soon, another strong reason to think twice before rushing to clear your debt. 7. Time is on your side. Inflation gradually reduces the purchasing power of your money over time. When you take out a mortgage, you borrow in today's dollars but repay the loan with future dollars, which will likely be worth less. Despite this decline in value, your repayment amount remains fixed. By securing a loan now and repaying it later when money has depreciated, you effectively reduce the real cost of your debt. Over a 30-year term, this strategy often proves more advantageous than a shorter 15-year mortgage. By leveraging time and inflation, extending your mortgage payments for as long as possible can be a smart financial move. 6. You should sink more funds into your retirement savings. If you're not fully utilizing your retirement contribution limits or need to make additional catch-up contributions, directing extra funds toward retirement savings may be a wiser choice. Accounts like a 401k, individual retirement accounts, IRA, or other retirement plans typically grow tax-deferred until withdrawal. Using surplus funds to pay off your mortgage instead may come with an opportunity cost, especially if your employer offers a matching contribution. This match is essentially free money that compounds over time, significantly boosting your retirement savings. Stay tuned, as we have even more reasons why paying off your mortgage too soon may not be the best move. 5. You can enjoy greater liquidity. Carefully consider the impact of using extra funds to pay off your mortgage early, as it can significantly reduce your liquidity. When you invest heavily in your home, those funds become tied up in a non-liquid asset, making it difficult to access cash quickly if needed. Selling the property to retrieve those funds can be a slow and complex process. Additionally, if all available cash is committed to the mortgage, you may have to rely on loans or credit cards, leading to new debt with interest. This is why it's essential to maintain a sufficient amount of liquid assets, such as emergency savings, stocks, bonds, or tax-advantaged retirement accounts that can be quickly accessed without penalties or fees. Having these assets ensures financial flexibility in case of urgent needs. 4. You could benefit from the tax deductions. If reducing your tax liability is a financial priority, holding on to your mortgage may be a strategic choice. The Internal Revenue Service allows mortgage interest to be deducted from taxable income, which can help lower your overall tax burden throughout the loan term. Additionally, paying off your mortgage early could negate progress made through other tax-saving strategies, such as contributing to retirement accounts or investing in municipal bonds. However, due to the increased standard deduction introduced in 2018, you may need to itemize your tax return to take advantage of this deduction. 3. You should pay off your high-interest debt first. Paying off your mortgage early may not be the best choice if you have other outstanding debts. Credit cards, personal loans, and other forms of debt often carry higher interest rates than your mortgage, leading to faster debt accumulation. To make the most financially sound decision, analyze the interest rates on all your debts and compare them to your mortgage rate. Prioritize repaying debts with higher interest rates before considering early mortgage repayment. As we continue exploring the 10 reasons not to pay off your mortgage early, let's move on to the next key consideration. 2. You should build an emergency fund first. Before paying off your mortgage, it's essential to ensure you have enough cash reserves to handle financial emergencies. A solid cash reserve can help you navigate unexpected crises without accumulating debt or relying on loans. Strengthen your financial stability by building an emergency fund that covers at least 3 to 6 months of living expenses. Consider keeping these funds in a high-yield savings account, which typically offers better returns than a standard savings account. As we near the end of this video, there's still one more crucial reason not to pay off your mortgage early. Let's dive into it. 1. You could make higher returns elsewhere. Paying off a mortgage is similar to securing a return on investment equal to the loan's interest rate. For example, if your mortgage rate is 4%, paying it off early effectively provides a 4% return over the loan term, which could span up to 30 years. However, if your mortgage rate is lower than the potential returns from low-risk investments over the same period, keeping the mortgage may be more beneficial. Instead, allocating extra funds to alternative investments, such as the stock market or other assets, could yield higher returns over time. As we wrap up this video, do these 10 reasons make sense to you? Join the discussion in the comments and share your thoughts with us. Thank you for watching. If you enjoyed this video, don't forget to subscribe and turn on the notification bell so you never miss an update. See you in the next one.